thank again Amber for allowing us to hold the meeting here in her conference room, and for NAIFA helping us with the lunch there. It's been a good partnership. And you'll see some people maybe that isn't quite, that you maybe recognize a little bit. A couple groups here. We have a group of independent agents, and we have a lot of agents that maybe belong to the Big I organization. Okay, another fine organization to maybe look at besides the NAIFA agents themselves. I don't know if my reputation preceded me or not, but there's no chair right here. And, you ever heard the speaker, Tony Campolo? You could Google Tony Campolo and some of his dynamic speeches that he's got. But Tony is known for spitting when he talks. He gets wound up so much that he does do that. So Tom and Everett, watch out. We'll get going on this. As I get older, I tend to forget things. I don't know about you guys, if that happens to you or not. At our office, I'm the last one to leave, and I can't tell you how many times I will get in the car, sit there and think, did I lock that door or not? It has happened one time, and that's what makes me think about it. So I kind of sometimes forget some things, and I don't mean to necessarily do it on purpose there. So I kind of write myself some little bit of notes here, a little bunch of mnemonics here for myself, okay? This one here, K&A, is what know your audience. This Sunday, I have the privilege, I'm a member of the Gideon organization, and we go around to various churches and speak to them in regards to our ministry of the Bibles like you see in the hotel and the motel rooms. Interesting, think of prices going up. The price of that Bible that's in that hotel room is $5, and it's been that same price for 75 years. It hasn't gone up. And average lifespan of one of those is 5 years. I have the privilege of speaking at the Keystone Community Church in old part of Keystone. It's kind of up on the hill there. That church is well over 100 years old. When Borglund was up there and his people, that's where they went to church. They went to church. Beautiful woodwork on the floor that they've redone. And it's got one of those, maybe you can remember old farmhouses that had the big grate. So right here is a great big grate. And the boiler's down there, and that's where the heat comes up. And you go down the stairs, it's a spiral staircase. And it's just barely wide enough for me to go down that spiral staircase. And they have a hole in the ceiling. And in that ceiling, it's got what? A rope. And that rope comes down. And of course, there's a bell. And when it's time for church, then you hear the old bell. But next Sunday, I have the opportunity there to not only speak to them about the Gideons, but do the whole service. Their pastor goes south to Arizona, and they look for them people to come in and do the service with them. But I've done this a few years, so again, in regards to knowing that audience, I'm very comfortable with that audience, and in speaking to them. So this is my Gideon outfit that I wear there. I thought, well, what better way to do it this group right here of knowing that audience. Their chairs are antique chairs. They're like theater chairs. And they flip up, and when they flip up, there's a piece of wire. So as that seat flips up, right here is a piece of wire right here. And dummy, I said, well, what is that for? The hymnals? They said, no. That's for their cowboy hats. They would actually, it's made to slide a cowboy hat when they come to church, right underneath there, and that would be to do that. So, a beautiful old church. Well, knowing this audience here in regards to the topic that we have today, it's business structures, executive bonus plans, and knowing this audience, whoa, a lot of these people already know these things here, okay? If you've been in the business less than 5 years, stand up. See?
Tom, sit back down.
Sit down. Okay, how about 6 to 10 years, stand up. Okay. And from 11 to 15 years, stand up. Yeah, some of you are counting. 16 to 20 years, stand up. 21 to 25, stand up. Barely stand up. 26 to 30, stand up. How many years, Thomas? 34. Okay. 31 to 35, stand up. So we see a lot of knowledge here. And one of it being then is that, you know, none of us is as smart as all of us. There's no one here, so there's not one person that is as smart as all of us in regard to the knowledge that we have. And so in looking at that, I thought, okay, let's take advantage of that. So I'm going to be splitting you up in groups. I will give you so many slides that then your group will come up and cover, okay? And at the end, then, I will need, which I know I won't need to, but then we'll summarize that, okay? So just let you kind of look. And in the packet that was given to you, of course, are not only the slides, but there's also material in regard to some of the subjects that you see in the slides, okay? Also, we made the slides that you have, that all the things are there. So if I'm speaking on topic A, then the drop downs are already there that's speaking of those things, okay? So we're gonna very much do audience participation. When I file this for CE, it asks, are you going to be giving a test? Are you gonna do a test? And I've never done a test in my CE. So this is as close as we can kind of get on a test there. So in that portion that you're looking forward to, no doubt now you're probably gonna, oh, I better look at this folder a little bit, okay? Because, and some of you have more experience than others, but we'd like, if you're in a group of 4, that maybe all 4 of you then participate in that as we cover that, okay? And probably gonna get more out of it than if you were listening to me going through all these slides. Okay, so that'll be some of the things there. Let's see some of the things that I wrote down here, okay? Maybe think in regards to your client's eyes. And when they think of life insurance, what do they think of? When they think of life insurance, what do they think of? Protection.
Peace of mind.
Peace of mind.
Expensive.
Expensive. Why don't they want to talk about it?
Want to avoid the issue.
That's it. In regards to this information I got, it said 8 out of 10 people, you ask them to think of life insurance, they think of death. That's what they're thinking of, is death. And they don't want to talk about that. Okay. They don't want to talk about that. We need to then collectively look at ways that we can put life in life insurance. In regards to some of the adjectives I heard of what life insurance does. So as you approach a potential client, think in regards to that maybe as a starting point. They're thinking of death. They're thinking of death. They're thinking of death. They're thinking of the high premiums that's gonna be, okay? You need to take the time to ask them questions so that you can bring what? Life into life insurance, okay? For those agents that have been maybe less than 5 years, but really for all of you, I'd like you to write these down, okay? There's not a slide here for you. You need to write this down, okay? I call these the 10 Commandments for Agents. The 10 Commandments for Agents. First commandment, thou shalt prospect, prospect, prospect. Right, Amber?
Yep.
Thou shalt prospect, prospect, prospect. If you never stop, you never have to start. And who's a prospect?
Everyone, until they disqualify themselves.
Commandment 2, thou shalt find a mentor. That's one big advantage, ladies and gentlemen, of us being here today, is we're able to, well, I maybe do mainly health, I may do mainly casualty, I may do just a group insurance. Fine, you're still, as Matt brought up, you're going to get something from that in regards to us coming together here. Okay, commandment 3, thou shalt honor thy firm. Honor your firm. At the end of the dance, you go home with who took you. Picking up on that then, thou shalt follow the firm's strategy. Thou shalt not kill thy career by doing something illegal. Illegal. I've been in the business over 45 years. Part of it, you know, I was manager with New York Life. And I'm sorry to say, in the different offices of that, there was 3 agents that we put in jail. One of which I had to testify against. And one of which, the gentleman in Fargo, and he was the nicest guy you'd ever want to, and so much participated in the community and everything. He dealt with an advanced premium scheme. Clients would give him advanced premiums. Back then, New York Life had, and probably maybe some of your others too, if you had a whole life policy, you could pay 20 years in advance, and then because you paid it up front, guess what? The company would discount it for you. Well, that discount, the clients were giving the check to who? Him. He was putting it in an account, and then the annual notice was going to him. He would pay the annual premium 1 year later, but in the meantime, he had what use of that person's money, but he had what, 20 years money, and of course, he just kept Ponzi, and just kept adding to it that they had there. Okay, so don't, you know, if it doesn't pass the smell test, Bucky, it doesn't pass the smell test. Okay? Thou shalt not lie. Number 7, thou shalt not steal fellow agents' clients or leads. Clients or leads. Thou shalt not stop learning. Always be, you've heard me say this before, maybe another one ever, what? Always be sharpening your saw. What am I doing? What did I do last week to sharpen your saw? If you want to be a professional, then never stop learning. What did you do last week to sharpen your saw? That's a question to the group. I'm listening. What did you do?
I read.
You read, okay.
Conference calls.
Huh? Conference calls, okay. Anybody else?
Yeah, watch the webinar.
A webinar? Very good, okay. Get in the habit of that. I looked on my LinkedIn and some of you guys were on there, and I picked up on some of the things that you guys sent. People in this audience here. just a habit of sharpening your saw. What am I doing to sharpen your saw? Okay, that's where this comes in. Are you looking at the clock, or are you looking at your compass? Are you looking at the clock, or are you looking at the compass? With all the emails we have, and phones and all like that, we're looking at the clock too much. And we lose sight of moral north, okay? Which sometimes can, frankly, put us in a pickle there, okay? If you get a consistency of sharpening your saw, that will help you stay, maybe, and emphasize more of that. How many right now in their emails would have over 10 emails in their email? Okay, leave your hands up, okay? How many would have over 15 emails?
Right now.
That need to be read? For how long? For a day or for an hour?
Like,
For let's say an hour,
oh, no.
20,
Yeah.
okay, 30. What am I gonna recommend for them, Rob?
Delete.
Use your delete.
Touch them once.
Touch them once, like a piece of paper. Touch it once, okay? We've all probably got a trash bin, right? Do you ever empty the trash bin? Does, even when you empty the trash bin, is it archived? I know with me, I have a trash bin, but even my trash bin is archived. So there isn't an email that you can't send to me that isn't in some already a file. So why leave it in your inbox? Look at it once, get rid of it. Get rid of it. When I go back, I will probably have maybe under 10 emails. Because when I left here, and we come to work at 7:30 in the morning, I made sure when I left here to come here with Jesse, that I had zero emails. Don't get the stress of looking at 35 emails. Stick it in a file, maybe even the trash file, okay? We need to do spring cleaning. Spring cleaning. I bet there's some stuff that's in the garage or in a closet. I mean, sometimes my tenure with New York Life, LaDonna and I, we'd have boxes that would have another stamp on it. In other words, it would have this particular moving company stamp on that box. And then we would move, that box had never been opened. They stuck another stamp on it. After a while, I said, you know what's in that box? Well, no, it's yours, isn't it? No, I thought it was yours. It's ours. Open it up. Get rid of it. Do some spring cleaning. Use the delete key. Use the delete key, okay? Thou shalt avoid negative coworkers. Now, I understand there's a mix, right? There's a mix, okay? They say that the optimist invented the airplane. The optimist invented the airplane, but the pessimist invented the parachute. So there is a certain amount of balance there. But, get rid of the stinking thinking. Do yourself a checkup from the neck up. And get rid of the negative coworkers, okay? Commandment number 10. Thou shalt not ignore thy client contact system. You need to have a system that you're going to be contacting your clients there. So that was my 10 commandments. Okay. Also in the realm of deleting things, okay, you are very, very, very busy associates here in regards to all the things that you do. And being responsible, being busy, a lot of times you have to develop the capacity to say no. Okay. And what I mean by that is, after a while, you're just gonna have too many monkeys on your back if you don't develop the capacity to be able to say no. Because you may have an associate that'll say to you, oh, have you got a second? And then all of a sudden, they are what are they doing? They are transferring that particular monkey on your back. Because you might say, oh, again, I'm looking at the clock, and I don't have time to look at this fully, but why don't you just lay it on my desk and I'll look at it and I'll come back with you with some suggestions. What just happened? That monkey just went on your back. That monkey went on your back. So you need to have the capacity to say no. Otherwise, it's gonna cause stress. What did I learn, okay? I would recommend that if you have the capacity to go to HBO documentary and look at One Nation Under Stress. One Nation Under Stress. Dr. Gupta, maybe see him on CNN. He's the one who's putting this on. For the third year in a row, and this affects us, the third year in a row of the ages of 15 to 55 in the United States for Caucasians, the mortality rate has gone down. Last time this happened was over 100 years ago. The mortality rate has gone down for 15 to 55-year-olds. And one of the big contributing factors to that is stress. Stress. All the different stresses that we go under. And to get rid of the stress, then sometimes there's what? Cirrhosis problems with alcohol. There are drugs problems with opioids, okay? Different contributors to that. But I thought, man, that is really, really something there. Another thing that I learned, and I'll be sending you non-NAIFA individuals an email. NAIFA has just started a program called Advisor Ambassador Program. Advisor Ambassador Program. If you are currently not a NAIFA member, then with this link that I send you, you can take online some courses that'll help you sharpen your saw. That'll help you sharpen your saw, okay? So these would be as April, it would be like learn exceptional prospecting practices, build your professional network of mentors, optimize your time and your cash flow. Those are all some examples of that. There'll be no charge for these courses. There's a course in April and there's a course in May. Okay, but I would highly recommend that you look at that. Also, what did I learn? If you take one of these business cards here, okay. We were lucky enough to have Stephen Wesselek and his associate Rochelle from Aspen Legacy.
Aspen Legacy.
Yeah, his attorney here in town, okay? Another thing that NAIFA is doing, they started yesterday. There is a long-term care center in regards to, let's say, almost in a form like an epidemic in regards to different things and needs that's needing for long-term care. Whether it be cuts in Medicaid, which then affect the states in regards to Medicaid benefits there, in regards to, we heard of what, Huron had a long-term care facility that closed right here with our own state. So it's nothing not to be aware of in regards to a long-term care a need there, okay? Stephen put out an article not too long ago. It says a little-known law forces adult children to pay for nursing home care for parents. This is already on the books, folks, this law.
And has been forever.
Yeah, it's already on the books, saying that children are responsible for their parents' expenses, like an example, long-term care. As there are as deep of pockets in Medicaid and other things, this isn't gonna be ignored. There will be, I think, a time in which this is gonna come around to do that, look at that very thing there. But Stephen at times does workshops. One important in regards to the card that you see is look in regards to the website. I get his newsletter. I go on the website and I'm subscribed to it. I get them. Again, it's a way that I can what? Sharpen my saw. Sharpen my saw in regards to that. So I very much recommend that. If you could mark down April, it'll be on, I think, a Thursday. I wanna say maybe it's the 26th or something. If somebody look at a calendar and tell me what that week of 25th, 26th, 27th, which one is a Thursday?
27th.
27th?
Nope.
25th.
25th, okay. On April 25th, that Thursday, there will be a lunch and learn at Financial Markets, okay? I filed for that to be a CE, but I don't know if it will be or not, okay? The purpose of that will be looking at long-term care. That's what that topic will be. And then if you can also write down, Bo, when was the golf?
June 14th.
June 14th. You can write down June 13th. June 13th is going to be a lunch and learn at the Black Hills College here in Rapid City, okay? They have a nice facility there. We're looking to bring in Rick Katz from American General. Some of you remember him speaking in regards to the, at the state convention, okay? To do that, I need butts and seats, at least double what we have right here. If everyone here would invite one person and bring them to there, then I wouldn't feel guilty in regards to Rick coming and putting on a thing there. But he has a really nice presentations that he has,
Yeah, he was really good.
along with different ideas that he had to share with that. Also, I'm looking in regards to having a speaker on cybersecurity, okay? Which some of you may have some guidance in regards to maybe some of your carriers, and some may not. But they will cover then cybersecurity, which is something that we need to look at. A lot of the big I agents will almost have a disclaimer where they will show the client, okay, I've looked into coverage for your home, your automobile, your business and things. I'm not gonna be doing my full due diligence unless I show you here in regards to coverage, in regards to the cybersecurity. If I get the organization I'm thinking of, I heard them around January, February, and at that particular week, there was a CPA firm that was being held for ransomware. And so the firm had some choices to make, okay? One, it's gonna take us 5 days to get our stuff from the cloud and get it going. In the meantime, we have to cancel 5 days worth of appointments at our most busiest time of the year. And of course, in your due diligence, explain to the clients what happened, okay? Okay, we're gonna have to, we need to explain it to the clients anyway. They went ahead and paid the ransomware, then went ahead and then explained it to all their clients and moved on from there, to go from there. So it can, you know, it's not just in on the coast and everything where we see things like that happen. And just think of something we know would happen in regards to that. He gives little hints like, use blind carbon copy, don't use carbon copy when you send things out. If you use just regular carbon copy, man, hackers can go right into that. If you use blind carbon copy, there's only one, me and the one person I'm sending it to. Everybody else that's in the blind carbon copy is more protected than if they were just up above in the regular carbon copy. So little things like that we're looking at and doing there, okay? So that would be June the 13th, okay, that we're going to do that. So you'll be getting some more things on that, but we need everyone's help on that. Okay, so let's look here in regards to, let's see here. I'm going to separate Rochelle and Stephen, okay? In regards to that. So one group that I've got that will be looking at, starting at, I believe it's slide number 4, starting at slide number 4, okay? So I've got Tom and Everett and Denise and Chris and Stephen. That's one group, okay? You guys will have, starting at slide number 4, okay? So you're gonna have 4, 5, 6. Okay, yeah, stick with those, that group, okay? So you guys, and again, you can look in some of the handouts in the folder, might have some things there for you. Oh, everyone's gonna get about 10 minutes to do that, okay? So Rochelle, you'll be part of the next group, okay? So I'll start with Rochelle here, and I'll go with, let's see. So I left on, what was your last slide, Tom?
6.
Okay, thanks, Tom and Everett, okay? Okay, so we're gonna start at 7, Rochelle. And you're gonna, you guys, this next group is gonna do 7, 8, 9, and 9 and 10, okay? So it'll be Rochelle, it'll be Rob, it'll be Laura, it'll be Randy, and it'll be, I'll stop there, okay? So you guys know what slides you got? Okay,
And the sport. And what?
all right, so we do have a in-house thing, a little advancer here, okay? So if you go, this one advances, guess what? You go the other side, it'll go back. High-tech stuff. But again, I said, what? No one, what, is as smart as
All of
all of
us.
us, okay? And we're gonna be an example of that here today. Again, what did I learn is, things kind of pop up, I like to share in regards to, and particularly you people on the health side probably know this, but this article gives an advantage of inpatient versus observation. And how that, just that definition can make a world of difference in regards to a claim. Inpatient versus observation. And as a person goes into the hospital, that's one thing to ask right away. Guys, what, Chris, can you expand upon this?
Well, it's with Medicare, there's so many, have you come into this, Tom? Because there's so many days that they're allowed for observation, and then when they first check into the hospital, there's kind of, whether there's the countdown, if they're going into a skilled nursing facility, or if they're going into a rehab.
Right,
There
so,
can be issues
in
with
the
that.
example in the article, they give Nancy and her husband broke his hip, okay? He was in there over 3 days, but they had it classified when he initially was admitted and everything, and left it that way as what? Observation,
Not a formal admission.
not a formal
He
admission.
would never qualify for
He
Medicare.
wouldn't have qualified for Medicare, and they got the bill, So it's just some little things like that, that's why they need you, okay? So, conversationally common, speaking of the different business structures here, and sometimes IRS and executive type programs here, okay? As we talk about some things, I'm not a lawyer and I'm not a tax accountant, okay? I'm not giving advice there, okay? So, some basics, things that we're gonna look at, and that you're gonna share with us in regards to the business structure itself, what is it legally then classified as, okay? And then you're gonna hear about a term, okay, maybe pass-through, not pass-through, okay? Then we're gonna speak in regards to, okay, now we know what the structure is, what are some benefits that we can bring things to life? Bring it what? Bring the business to life with what? Life insurance, with life insurance, and there's some different, things to do this, particularly looking at who's gonna take over your business, who's gonna take over this, this business here, okay? And then, those valuable key employees, those valuable key employees, all the time and efforts that you spent to teach them in regards to that. And in your business, and this business is no different, as Steve can say, and Rochelle in their business, it's like learning a whole new language. and you're explaining to people, kind of in the language that you are comfortable with, in regards to what you have to do. Well, the succession plan, you've had people on your staff, part of your family, and what are ways that you're going to then hand it down, okay? And look at these key employees. And then we'll talk a little bit about some IRS codes that we kind of know of, and that we use and everything, just to get comfortable with that, okay? And so then, is that number 4?
Yep.
Okay, so I'll turn it over to this next group.
Where's the clicker? Is this it here?
Yep, right there, right there.
So I'm gonna go back a slide and touch on the last one, the last couple, this one here. And it says there, clients should always consult with their tax and legal professionals. So you folks are predominantly insurance and financial professionals. You may be a tax professional, I don't know everybody in the room, but someone may have a tax background as well, or you've taken a lot of time to study those issues. But it's real, I like to refer to this as collaboration. And as an attorney, when we work with and talk to clients, I emphasize the importance of collaboration with other professionals. They're already retained professionals or making referrals. And in our world, in estate planning and elder law, that's gonna be tax advisors, insurance and financial advisors. Vice versa, you're looking for tax counsel or advisors and legal professionals. So it's a team effort, just like he says over there. No one of us is smarter than the rest of us, or all the rest of us, or whatever. So that's really important. But let's start right here, and I'm just going to, I got picked to do this, and I guess it's just fortuitous that I was here today. Because this is what we do. I live and breathe this part of it. Okay, so the first slide really focuses on, I was gonna go back to this as well in the invitation that we got from Ed. It says basic business structure and executive benefits. And when I see this, what I think of in particular is tax. Because different business entities treat benefits differently. And I'm gonna touch upon that, and then some of the other slides get into a little more detail. And so when we talk about the business structures, this is the foundation or the fundamentals before we get into the other issues, which you folks are more involved in, which are the benefits. And so when we talk about the basic business structures, when I have someone who comes to me and says, I'm engaged in an enterprise, I'm an entrepreneur, we know that most of the businesses in America, right, are small businesses. Most of them are the mom and pop type shops. Maybe that's your experience in your book, in your portfolio. Just folks who are trying to eke out a nice living and create a future for themselves. And the notes here talk about different structures have different tax rules, non-pass-through and pass-through. When I'm asked about a business formation, we're going to be asking not only about tax, but there's a line that's drawn here, and that's really the line below partnership. So we have sole proprietorships. If I am just Stephen Westlick, attorney at law, and I have no business structure, that's just me, I'm a sole proprietor. One of the things my group asked was to ask me to ask you is just to have a show of hands. How many of you would fall into a sole proprietorship? Oh, wow, okay. How about a partnership? How many would be partnership with someone else? Okay. How many of you are some form of a corporation? Okay. And how about LLC? How many of you are LLC? There's a slight difference between a corporation and an LLC. Okay, sometimes it's significant, but mostly slight. So I like to draw the line between here and here. A sole proprietorship and a traditional partnership will be somebody who does not have a protection for limited liability. That's why we have corporations and LLCs and other limited liability entities. And there's a variety of them, limited liability partnership and on and on and on. But the more common ones are corporation, forget the S and the C, corporation and LLC. Corporation is the oldest form that was recognized centuries ago to provide some formal structure to a business enterprise, and it's evolved into providing limited liability that separates the liability of the business enterprise from the assets of the owner. Does that sound common? You've heard that before, right? If I'm a shareholder in a corporation, then if the corporation has legal liabilities, in most cases, I'm not personally liable for that. Just the assets of the corporation are. And so that's the big difference here between these two structures, which is proprietorship and traditional partnership, versus corporation LLC. Now, a partnership can be set up as a limited liability partnership, an LLP. You've heard that term. But that's a big difference. A benefit to having a formal structure as opposed to a sole proprietorship, if I go to a flea market and I have a booth and I sell my wares, how attractive is that for somebody to buy? Probably not too attractive. But if I have upped my game and I have put together a business organization that's building credibility, I might be able to acquire capital investment or sell the business at some point. So one of the reasons someone goes into a formal structure is increased credibility of the business and transferability of the business interest. It's easier to sell shares in a corporation than a piece of my enterprise in some instances. So those are some of the basic differences. They do have tax differences. If we're a proprietorship and a partnership, we're taxed at the owner level because there's no formal business structure. We're just taxed, income tax. When I sell something, I have to pay income tax. Likewise with a partnership. A partnership is defined as two or more persons who are in business together in an enterprise, usually for profit. You can't be a single partner. You have to have at least two. And if you have more than one, you can't be a sole proprietorship. Basic stuff there. When we talk about the taxation with the corporation, you can be a single shareholder, sole shareholder corporation, or you can be a multinational corporation. You could be Coca-Cola, Microsoft, whatever. So an LLC is a limited liability company, and in more recent decades, legislatures across the state decided, let's provide some flexibility. We don't necessarily need a board of directors and all the formalities of a corporation. So we're going to create something called a limited liability company, and it's run a little more informally, like a partnership. Doesn't have all the requirements necessarily of a corporation, but these are all some forms of legal liability, limited liability organizations. When we talk about the S or the C, if you know anything about tax at all, you know that's just an election under the tax code. Will the entity be taxed as well as the owners? I told you up here you're taxed only at the owner level because that's all there is, owners. When you talk about S or C, then what you're asking is, are we going to tax the business entity as well as the owners? The income that the corporation earns, subject to income tax, and when distributions are made to shareholders, taxation to them for those distributions. Double taxation versus, that's what a C Corp is, double taxation versus S Corporation. I have a corporation, I'm an S Corp. I file an information tax return, but that is not taxed. We report the income, but we get a K-1 that's reported to me individually as the owner, and I pay all the tax at my level. That's the difference between C and S, double versus single taxation. That's why it's called a pass-through entity. An LLC can elect to be taxed as a corporation, number one, or as a partnership, number two. Now we're getting to areas that I don't know too many details about, but I do know that. An LLC can be taxed as a partnership or a proprietorship or as a corporation, and if it's taxed as a corporation, it can be taxed, elect to be taxed as an S, which is single taxation, or pass-through, or C, which is double taxation at the business level and the owner. So those are some of the weeds that we get through. For the purpose of this discussion, I think it's important to understand from the outset that a C corporation being taxed at the business level is usually going to recognize the tax code will grant more exemption, deductions there, including benefits. Fringe benefits are usually going to be more allowed as deductions under a C corporation versus an S corporation or a pass-through entity. So for the following discussions, that's very important. Then we just get into this. I've already covered actually a lot of that already, so I'm going to skip over that. Pass-through, there you see, these are all pass-throughs versus non-pass-through. Double taxation, that's what that means. Double taxation. Even if you're a pass-through entity, as an S Corp or an LLC, you may have to file information tax returns, but you don't pay income tax. You file the return. It's treated as a disregarded entity for tax purposes. And then this is the sole proprietorship. It's just me selling my wares at a flea market, or me as a lawyer in an office. There's no formation documents. no double taxation. I have all the liability of the business. My personal assets are subject to that liability. You can only be one, you can't be more than one, et cetera, et cetera. So, there you go.
I gotta tell you folks, for that group session that we had, I didn't have a lot of time to teach him that stuff. Let's hear it for Steve. He was a quick study, no kidding.
What was the number one commandment? Prospecting, okay? Maybe, and kind of being yourself a little bit different than anyone else, would be to ask sometimes businesses, when you're prospecting, are you a pass-through or a non-pass-through? That's kind of a term that you don't hear out there every day, okay? And so the purpose of me asking that question is what? For them to turn around and ask me a question. What do you mean by that? Pass-through or non-pass-through, okay? You know, you're a very successful business in regards to that. Strider Bicycle, are you a pass-through or a non-pass-through entity? Well, what do you mean by that? I'd have to ask my accountant. Well, are you? Then you can go into the other things, okay? And again, prospecting. What recent development happened in regards to the tax bill in regards to the pass-through entities?
Or at that point, when they say we don't know, I need to ask my accountant, just say, well, how about if you and I go see your accountant?
Well, if you've done your homework, you would know the answer to that. That's not the purpose of you asking a question, that you find the answer to that. You need to do your homework, and you already know that. And you got public records to help you find that kind of thing. But when I ask that question, I want them to know that they don't know that. And as I understand it, you are this, and I speak of that, okay? In regards to the pass-through businesses, some of them in a certain classification will get the 20% deduction. The 20% deduction.
When they eliminate other deductions.
Yep, with that under the new tax law.
Tax law.
With the new tax law, okay? Opportunities there. Very good. Okay. Next group.
Oh, is this one guy?
No, it doesn't have to be one person. You can go up there as a group or wherever you want.
I know what you did as this group, but partnerships are pretty simple. I mean, we covered this kind of earlier, but it's really when we're talking liability. Partnership, if Tom and I are in a partnership, we're both equally liable to anything we have going. Whether I've only put in 10% of the company and Tom has put in 90% of the company, I'm still fully liable and Tom is still fully liable, unless we've come through and set up an LLC or something else between us. But strictly just a partnership, unlimited liability between both of us. Distributions to partners don't have to be equal. I own 10%, Tom owns 90%. When we have distributions and we do well, Tom gets 90% of the profits, I only get 10. No double taxation. It's strictly just a pass-through, just like what we've been talking about earlier. Disadvantages, unlimited liability for general partners, just kind of like what we talked about. If Tom does something bad, I am fully liable for anything Tom does. And vice versa, I only own 10% of the company. Anything Tom does, I'm still fully liable, or vice versa. Partners, that's pretty easy. S-corps. S-corp is what most of the businesses that you run into, if they have more than one people in them, not a general partnership, they're gonna start turning into S-corp or small corporations. Shareholders have limited liability. I'm only liable for what I have in this corporation with Tom. I threw in $10,000 in this thing and the whole thing blows up, I'm only liable for my $10,000, whatever that portion of the company that I own. No double taxation, like a C Corp, doesn't work that way, it's taxed at my rate or our rate. Shareholders will report their shares to the business income and their personal, it strictly goes in your personal tax return. Disadvantages, limited to 100 partners or 100 shareholders. Pro rata distribution, I own 10%, Tom owns 90%, he gets 90% of the good, I get 10%. Well, maybe he has a savings, charitable organization, stuff like that. Not a whole lot more to that. Limited liability corporations. Limited liability corporations have been around for how long?
A few decades, 50 years.
50 years? All right, I don't know how long they've been around.
Yeah,
They're
fairly recent.
fairly recent though. 50 years sounds like a long time, but in all actuality, it's not been that long. Advantages, liability. I am protected by the amount that I put in here. My general assets, my house, my home, everything else is protected, even if our business, if Tom does something stupid and causes our business to go belly up.
I'm capable of that.
Can't have unlimited number of members. We can have 100, 200, whatever we want to do. Everybody participates. Can be taxed as a sole proprietor, partnership, or corporation. There is no double taxation because it won't be set up as a C Corp. I guess we could have a C Corp with an LLC put it to it. LLCs kind of got started somewhat from the professional side. Doctors, you see PCs, that's a professional corp. Dr. Jones, PC, professional corp, he's only liable for what he has in there, right?
And extended who can be owners to other licensed professionals.
There you go. Disadvantages, more legal uncertainty due to hybrid nature and lack of history. It's only been around for 50 years. Not as many laws on the books as other corporations. C Corp. C Corp, advantages, shareholders, limited liability. I'm only liable for what I got in it. Executive benefit plans are suitable for this type of entity. Long-term care is a great one. I get the corporation, as a corporation, I'm buying long-term care on Ed. I'm gonna buy that for him as a benefit. Me, the corporation, get to deduct it. When I'm doing this in a C Corp, or I'm sorry, an S Corp, that's not necessarily the case. But a C Corp, I get to deduct it, and Ed gets to take an advantage of it. He does not have that as a benefit to him, so it's not taxable to him. I get to deduct it, he gets a benefit without having to pay for it. Disadvantages, double taxation. Can be a good and a bad thing. Double taxation, if Ed is a billionaire and I have $10,000 to my name, the corporation is going to get taxed at its corporate rate. Corporate rate being 20%. So it'll be taxed at that rate. Ed, once he receives the money out of this, he's gonna be taxed at whatever rate he's in. I'm a very poor gentleman. I'm in a very low tax bracket. The corporation is gonna pay tax on their profits. As I get a dividend, I'm going to pay tax on mine, or shows a profit coming my direction. Most expensive entity to maintain. C Corps usually do not make a lot of sense unless it is a very large corporation. We just don't run into them very often. Used to see them more when tax brackets were different, but in today's world, you run into very few of them. I think all of you have gotten reports when we talk 401ks. You can go through see who the C Corporation is here in Rapid City. We have very few of them left. Anything else? All right. Very good.
Okay, so as they went over the 4 business entities, there are 7 business strategies for these business entities. As you can see, you got an executive bonus plan, the restricted executive bonus arrangement plan, a non-qualified deferred compensation plan, key person life insurance, buy-sell, cross or entity purchase, buy-sell one-way, and a split dollar. As you notice, C corporations, you can use all the 7 business strategies in order for that corporation. As you come back towards the sole proprietorship, you're limited in the types of business strategies that you can perform just based off of, usually because it's only a 1-person group at that point.
So your succession plan, these are really the common elements you need to talk to the businesses about. First thing you really need to do is identify the sellers and the buyers, and then you need to decide what's going to trigger the buy-sell agreement. If that's a lot of times that's the death, and that's why you have the life insurance. You want to determine the price of the company, and that way you can get the right insurance in place, and you want to list the payment provisions. So, I don't have any more
All
details
right,
on that.
sounds good. All right, so just talking about three different types, gonna get more what Bo said as far as on that list. Three of those were cross-purchase, entity purchase, and one-way. Again, different types of buy and sells, and they're different for different applications for different businesses. The cross-purchase is literally where you have, most common would it just have two owners, and they buy a plan on each other. So each owner buys a part of the interest, and the basis is stepped up to the purchase price, whatever that determining was. Entity purchase is where the business actually goes in and buys the interest on the different owners. No base step up with that redemption. And then the one-way is a non-owner individual, usually a key person or a manager or someone that you want to take over the business at some point, and that basis equals the purchase price on that one. So again, the payment provisions, a lot of times I went into different companies and we talk about, a buy-sell agreement or something, it's like, oh yeah, we've got one of those. Well, then the next question is, then I say, well, how is it funded? Well, a lot of people kind of look at you like, well, what do you mean? Well, yeah, you have an agreement in place, but something's got to, if there's a trigger that happens, a death, or a disability, something like that that's gonna cause that, who or what's gonna pay for it? So how that's paid for is obviously from the surviving owners, whether it be a lump sum or some type of installment plan over the course of years. Of course, there's life insurance, so that's the most common thing for our industry as far as we try to kind of fill that void with that. And then, of course, you can go to a bank for a loan, but then sometimes you look at it, it's like, well, if one of the main owners has just passed away, maybe they're not in the ability to that bank, maybe not that attractive to lend to that business that just had their main owner pass away. Or obviously it could be a combination of all of the above, but that's it.
Very good. There you go.
With the big one.
Okay, so optionality triggers. You obviously have two main categories. Either the person who is a partner or an owner in the business is no longer gracing the world with their presence, or they need out of it, either disabled, they're retiring, they've got a divorce that they've got to take care of, bankruptcy, or they were terminated.
So in the succession plans that were mentioned previously, there's the cross purchase, which is basically all of the owners buy an insurance policy on the other owners, and so I guess I'm not gonna probably follow that whole thing through, but if there's a death of one of the owners, that money is gonna be paid to the beneficiary are the other owners, correct? And then that funds the buy-sell agreement to purchase that the surviving owner's spouse or whoever received the business interest. That's the cross purchase.
Perfect. A little bit different from the cross purchase, we have the entity purchase. Now on the entity side, instead of the actual business owners owning it, the actual business itself will own, maybe in this case, a life insurance plan. Then in case something were to happen to one of the actual business owners, since the business owns it, the death proceeds will go to the business, or then the business will then in turn pay off the heirs or the spouse for that set of shares or their portion of the actual business. Typically on something like that, the premiums are not gonna be deductible on that for you, for the business or anything like that. And entity purchase are really good, especially when you're dealing with a wide gap of different ages, especially if some businesses might have 5 or so business owners. You might have anywhere from 35-year-olds all the way up to 60-year-olds continue to work. For this year, the business then in turn goes out, buys the policies direct, and then it'll be paid out back to the business upon death. Yep.
So, to summarize, your entity purchase, you're gonna, the two main differences that I see with this, your entity purchase, you're gonna have one policy per owner. Where if you do your cross purchase, each owner has to buy a policy on all of the other owners. You can have multiple policies going on. It just kinda depends on how you got it set up. So if you've got a couple, 2 to 3 owners on that cross purchase might be your bet, but if you've got 10 higher ups than that, you might wanna look at the entity purchase.
That business's accountant will need to file this form every year, every single year. What do we have? We have an employer that is the owner of a policy on an employee. And at the time of the application, a letter of acceptance needs to be done, meaning the employee knows it and accepts that, okay? And of course, then when they're tax filing, they need to file this form. If they don't, then the proceed as a receipt is taxable to the employer, okay? So you want to know on the good side as you're looking at these business agreements, you want to maybe make a sample of this and say, hey, you might want to share this with your accountant. He or she's going to need to file this every year. So next year, there is no new employee, but they still have to file it on the employee that they did the year before to do that, okay? And we can thank Walmart for this form here. They wrote life insurance on their employees. The employees did not know it. And then Walmart was the beneficiary of those. And the result of that was this. I think that the employees should bring up the next group then.
I've got to thank you, Ed, for this. Me getting up here and doing this, I'm actually earning beer. I've just told, so.
You are beer.
I know.
Which one's
The one on the right.
That's it, right there. Yeah.
Let's say, so the last purchase agreement that is out there that we're gonna make reference to is a one-way buy-sell. With this particular plan, it has some unique things that are with it, is that it's a one-person owner, and he has a key person that he's trying to help reward, as well as create a buyer of his business upon his passing, his retiring, etc. So it's unique in that, in the sense of the key employee that's out there, how he has a stake in it, or a big stake in it, is that he, if his person owns it, retires, dies, whatever, well, he might be out of a job as well. So what this does is that the key employee, actually, they agree to allow the employee to buy an insurance plan on, the owner. So for example, Ed and I are in business together. Ed's the owner of it, but I wanna take over his business. So what I'm gonna do is I'm gonna buy a life insurance on Ed that I, actually, in this instance, he could bonus me back the money to actually pay for the insurance plan on him. I in turn get to pay taxes on that, right? Because it's an income to me. Well, we have a great arrangement with us, is that Ed also is gonna give me an extra bonus to help pay for the taxes on the bonus. Okay, that's something you can implement in this. It's not necessarily the case you have to, but you can. So then something happens to Ed passes away. Well, we agreed that I have an insurance plan that I own on him, and we have an agreement in place that says that he is going to, his estate is going to sell the property, the business to me. I am now gonna be an owner of it, and I'm gonna use the insurance proceeds to, of course, buy his estate up. So his wife is happy, I'm happy, everyone's kinda happy in that situation. What am I missing on there? I think that covers that particular slide on there. So when you're talking about the succession plans, there's 3 things that you have to talk about. What is it? How is it funded? How does it work? Who pays the premiums? Do the remaining shareholders, owners receive a basis increase? We kind of talked about that, the other guys have. And for whom does it work the best? And in each of those instances, they're all a little bit different. Something that I didn't hear mentioned, but maybe I missed it. When you're talking about a cross-purchase agreement, the more the partners that there is out there, the more policies that there are. The formula that you use is if we have 4 partners in the business, and there's buying insurance plans on each, you take the number of partners minus one, take that times each other, and that's how many cross-purchase ones that you would have to purchase. So in that case, you'd have to have 12 policies out there if you have a cross-purchase. If you have an entity purchase, then you actually buy 4 policies on the owners, the business that owns that. I didn't hear that mentioned, so I wanna make sure. And of course, the one way is just one plan where I buy it on the owner, so it's one, policy. And as we know, when we sell insurance plans, if the more policies you have, about policy fees, things like that, that it actually costs more to have more than any one together, because you also might miss the break points on the cost of insurance too, but, the executive benefits of, I think this is talking about things you need to be concerned with. From the employer objectives, you usually desire, the usual desire with handcuff and the deduction. So when you're handcuffing an employee, handcuffing somebody like that, that means that you are obligating them to buy the, business from you. And it's, agreed upon, agreement ahead of time that says that you are saying that if I retire, if I die, you are gonna be buying this from me at a set price, that you agreed to, in the agreement. But usually, you try to get both that and a deduction for what you have. So when I made reference to having the bonusing, Ed's gonna bonus me money to buy a life insurance plan on him, well, because he's paying it through a wage and not a premium, he's actually the business is gonna be able to deduct that as a wage. So, in that sense, he's doing that. But if the business paid for the premium straight, then he won't be able to deduct that because it doesn't come through me as a wage. And let's say that he did deduct that as a bonus, he paid for it directly and deducted it. He passes away, all of a sudden the life insurance, that's valued out there, all of a sudden that now becomes taxable. So you can't have it one way or the other. So you have one way or the other, but not both. So obviously the handcuff is an employer-owned policy. I'm not sure what the CERP endorsement is. Did I miss that?
No, it's covered later.
Okay. So obviously, the employee-owned policy, it has a deduction, associated with it, and it's considered like an executive bonus essentially. This was a slide that, what I gathered from it was talking about the, helping employees replace their, income during their retirement years. And as your wage goes up on the top from 50, 100, 150, 250, that your contribution that you put into the 401k from the employer standpoint is, if they're putting in 10% of their wage that's out there, and then they have their benefits that are growing in the account, and when their Social Security is added in there, essentially the bottom line is saying that the higher the wages that are out there, the less that you can, potentially replace, through traditional methods, from 72% down to 36%. The reason that is because Uncle Sam puts limits on how much you can put into those accounts. And then of course, Social Security is only, caps out at what dollar amount? Anybody know what that is?
2,900 or something.
But it's, like a certain dollar amount, you
Like
lose like
120,
110, 120.
some
Yeah.
odd.
So you don't pay Social Security benefits beyond that, while on the far end of the scale, obviously they're not dumping in as much. So where this comes into play is that if you're getting the executive bonuses and you're bonusing you're bonusing the employees more, then you're able to supplement more of that and maybe replace more of their income. So benefits to do an executive bonus is that it's deductible business expense. The key thing out there too is that you can discriminate. You can't do that in the real world, based upon race, creed, and everything else, but you can do it in the sense of, your key employees that are out there. And there's no qualification or qualification or reporting. As you know, with like 401ks, simple IRAs and things like that, there's, things you have to report. The simplest one is the one that Ed made reference to. You have to file every year on like the simple IRAs, things like that. But when you get into the weeds of the 401ks, there's a lot more associated with that with the normal organizations. In this case, there's no annual administrative costs, and the detriments is there's no handcuffs. If you're bonusing someone, you can't handcuff them. So when it comes to a key employee, the benefits are it's a portable permanent insurance plan. If they leave the business, they take it with them. Income tax-free access to cash value in plans, because normally they are funded with, permanent insurance plans. And of course, income tax-free death benefits. And the detriments is they have to be insurable. So the REBA, and a picture of REBA out there. So restricted executive bonus arrangement, the employee owns the plan. It's an agreement between employer and employee. The endorsement is executed with an insurer that restricts employees' use of the policy's cash value. I've actually never done this, so this is kind of a new thing that I'm learning today here. So endorsement triggered, or releasing on triggering events such as retirement, disability, specified age, number of years, death, mutual agreement, etc. So that's essentially a executive bonus agreement, but it has restrictions that you've put onto it. That's the big difference between it.
And kind of makes that handcuffed and
Okay.
more viable.
Okay, I think that's it. To succeed in life, you need 3 things: a wishbone, a backbone, and a funny bone. Amber wanted me to say that.
I want that for sure. Get that in there.
Next group.
Good job.
All right, split dollar life insurance policy. So split dollar arrangement is basically a method of purchasing life insurance. The premium payments and the policy benefits, either one, the other, or both, are split between 2 entities. The parties involved in that can either be obviously employer, employee, 2 separate individuals, or an individual in a trust. Important note, it is a method to buy, not a reason to buy. There should always be a underlying need for life insurance that we're trying to identify and sell first.
Thank you.
I'll just run.
Okay. The advantages for the employer and employee, for the employer to recruit, reward, and retain, it's discriminatory and no IRS approval is needed. For the employee, it's life insurance at reduced current out-of-pocket expense.
Okay, and there's 2 common types of split dollar life insurance policies, and they're determined by how the policy ownership is set up. With the endorsement method, the employer owns the policy and endorses some of the death benefit to the employee. Under the endorsement method, the employer owns the policy, and the agreement spells out the employee's rights, typically including the right to name a beneficiary for the employee's share of the death proceeds. So maybe their family's getting something, and then the owner of the business is getting something too. At the employee's death, the life insurance proceeds are split between the parties. The employer typically receives a return of premiums only, a return of cash value only, or a return of the greater of the premiums paid or the cash value. The employee's beneficiaries receive the remaining proceeds.
On the collateral assignment method, the employee rather than the employer owns the policy, and the employer loans the premium to the employee. Employee must pay interest and be taxed on imputed interest. The ownership of life insurance is used to fund the split dollar arrangement under the collateral assignment as an important tax consequence under regulations used by the Treasury Department. When you think of Treasury Department, what do you think of?
IRS.
And you're not going where I want you to go. Earlier in the meeting, Ed said when you ask people about life insurance, what do they think of?
Yeah.
When somebody says
Tax.
Treasury Department, what do you think of?
Tax.
Death, because you'd rather die than have to go to the Treasury Department, right? So same kind of issue. And this kind of wraps it all up for you right here. In the interest of time, we're running over late, so I'm gonna, thank you very much. Good job, Drew.
Okay, we're on the home stretch here. All these different phrases and stuff, keep it in language that the audience that you're working with there. So, and this is what this one looked at in regards to not using the phrase of split dollar, rebas, or whatever. It just says employer. Do you want to pay what? Some, all, or none? Benefits, employer. Do you want some of it back of what you paid, or none of it? some of it or all of it back, okay? So asking those questions in regards to, again, the commandment number 1 of what? Prospecting helps you in regards to that. Here's some samples of some IRS codes. Section 79 deals with group insurance, times the 50,000. That's section 101. Again, this came about, the form 8925, in regards to employer owning insurance. Section 162, meaning that these benefit plans that we spoke about, then this section then means that, hey, this is a viable employer business expense that we could see that they'd be paying for. Even so much as the example of the long-term care that Rob brought up there, okay? 401, we know about, someone bring an example of what 401K, okay? Section 409 allows us to have discriminatory, non-qualified compensation plan. And section 7702 deals with life insurance, including what their cash value. When we get into the phrase you hear sometimes of what? Modified endowment. Modified endowment coming into play there, okay? Okay, so just a real brief summary here a little bit. But have you sharpened your saw tomorrow?
Just did.
Have you sharpened your saw, okay? No one of us is as smart as all of us. Okay? And what prompted this particular style, I hope you kind of enjoyed that, is this. Of course, this old man always got a story to tell, okay? So here goes the story. The story goes, there was a professor, and the professor had a young associate that traveled with him. And they went around and then they give these seminars, okay? As they did, then they were traveling, and the associate's in the car, they're talking and everything, and the associate says, you know, I think I could do that seminar. I've heard it enough times, and I think I can do it. And so the professor says, go ahead, okay, Jesse, next time that we go, you will be the professor, and I'll be the associate. And sure enough, then, Jesse took the next webinar, and man, she did it to a T. And there was question and answers, and she still handled them, okay? So then they're going to the next place, and she starts to get a little confident in regards to that. And the professor says, you know, it's always good to what? Know your audience, and be able to what? Think on your feet. So she's going along, and then all of a sudden, there's one individual, kind of like a Rob Kerstead puts his nameplate upside down. And he is asking her questions, just question about her. He is really trying to drill her, but she handles it like a trooper, every one of those answers. Then he asks that one question, and you could tell it in Jesse's eyes. She did not know the answer to that totally. So there was dead silence, and she was silent, quiet for a while. And she says, you know, Rob, that question is so basic that my intern and my helper, Ed, can answer that question. Good plan. So, I was getting over kind of a cold, and I knew I was maybe gonna have to drink a lot of water, and so I looked at it and said, hey, know your audience. You guys know more about this than I do, because you're at the front lines. And indeed, you all come through very, very good. So, I thank you with that. If there's anything else for the good of everybody, otherwise, thanks again. If you wanna leave your name tags, please, okay? Again, the next Lunch and Learn will be in April. It'll be on long-term care. You'll get information on that. And then start recruiting for June. Okay, thank you.
We have our
Thanks,
50.
Ed.